Storm season. From pipeline leaks in the North Sea to emergency repair of a broken gilt market in the UK to Hurricane Ian rampaging through Florida. This is Bloomberg Wall Street Week. I'm David Weston. This week, special contributor Larry Summers on the Bank of England's abrupt move to shore up the British bond market.
We're in very complex and uncharted territory with what's happening in the UK.
And Nuveen CEO Jose Minaya on seeking refuge from the storm in the market.
It's not just about stocks and bonds. Now it's about alternatives.
It was a week of stormy weather, starting with unexplained leaks in the Nord Stream pipeline off the coast of Denmark, something Special Climate Envoy John Kerry says is a real risk for the environment.
This is a massive leak bubbling up under the water. Methane is 20 to 80 times more damaging than CO2. So it has a profound impact in adding the amount of methane in the air.
A major storm hit the market for British government bonds this week, triggered by the new government's proposed tax cuts, which had unintended consequences for the big pension plans as gilt yields shot up, requiring the Bank of England to step in, as explained by former MPC member Kristen Forbes.
We are now in that situation every central banker doesn't want to be in, where the fiscal side is going in a direction opposite what the monetary side is trying to do.
U.S. banks weren't immune from the stormy weather either, as major banks were hit with $1.8 billion in fines for improperly allowing their employees, even some executives, to use social media outlets outside the record-keeping requirements.
Regulators reached settlements with a dozen banks for failing to monitor employees' communications on unauthorized messaging apps like WhatsApp.
And then there was the big storm, Hurricane Ian, that came up through the Caribbean and slammed into Florida, causing destruction we're still getting our arms around.
The pictures that were coming out of Florida were that was just lifting cars up and floating them down the street. You had before and after pictures of these beautiful little homes, and then all you could see is just the tops of the roofs. So the storm surge lived up to the hype, but it really did a lot of damage.
And the markets, they reflected all that stormy weather, with stocks closing down for the week, down for the month, and down for the quarter. The S&P 500 lost 2.9% for the week and closed the quarter at the lowest point in 2 years, finishing under 3,600, while the NASDAQ gave up 2.7% for the week, down 4.1% for the quarter. Bonds sold off as well, with the yield on the 10-year up 13 basis points since the week began, ending up at 3.82. And here to take us through another tough week in the markets are David Bianco, Chief Investment Officer at DWS America, and Lori Calvasina, Head of Equity Strategy at RBC Capital Markets. Welcome, both of you, to Wall Street. Good to have you back. So let me start with you, David. The most basic question, how bad is it going to get?
How bad is it going to get? Well, thank goodness it's Friday. The weekend should be a reprieve. Tough day, tough week, tough year. The S&P 500's down 26% from its all-time high. This is a bear market. I find myself thinking about the 1970s lately, and I think something to keep in mind is that the 1982 bear market, when the Fed was fighting inflation aggressively back then, the S&P fell 27, 28%. But in 1974, the S&P fell 48%. So I think a key question is this the beginning of a high inflationary period, or are we near the end of a high inflationary period? If you think we're near the end of a high inflationary period, the worst is largely behind, and the market shouldn't go too much further down. But that's the key question.
Lori, I'm not feeling much better. What do you think?
All right, I'm going to try to make you feel a little bit better. So look, we think that the market is set to stage a major battle at the 3,500 level. And the reason for that is if you look back over the course of recessions into the 30s, a median recessionary drawdown is about 27%. And so we'll get there when we're around 3,500 on the S&P. And I still, as I talk to investors, I think many are still in the mild, kind of quicker, shallow camp, but do think there's going to be a sluggish growth backdrop afterwards. I think people are not really looking for anything major like what we had in the financial crisis. So I think that at least we've got that at our back. I will tell you, if you think about kind of where investors' heads are at, something else that makes me feel a little bit better is I'm not sensing a ton of panic, definitely alarm. But the big question of the day is, what do higher rates for longer mean for valuation multiples? And that's a very constructive conversation. And we've done some work suggesting that we're probably getting pretty close, if you hit that 3,500 level on the S&P, to the same kind of multiple contraction you saw back in the 70s over the course of the entire decade.
I want to come back to earnings, but before that, we just heard from Lori, short and shallow, I think you said. I think she's referring to a recession. Are you projecting a recession? And I guess my question really is, normally if you have a recession, we turn our heads and look at the Fed and say, okay, please cut rates. Do we have much room to really deal with the recession if and when it comes?
We're expecting a short and shallow recession, but we're a bit concerned that the troughs might linger well into 2023. We're not expecting a V-shaped recovery after the small recession. We think it's going to be slow, real growth afterward. The trouble here is that the Fed can't rescue us because of the inflation problem, and they can't attempt to rescue the equity market or even the economy broadly until they're confident that the inflation battle's been won. So I think people know it's pretty clear at this stage the Fed is committed to fighting inflation, and they've decided they're willing to risk a small, moderate recession, tolerate one, to make sure that this inflation beast is slain.
So if we're talking about equities, just for a moment, you got at least two things going on. One is valuations and what we're expecting, and the higher discount rate affects that. Also earnings. What are you expecting on earnings?
At this stage, we're expecting earnings for 2022 to be $225. I think at this stage, you should not expect any growth. It should be flat in 2023. But every day that goes by with the shocks that we're experiencing, higher interest rates, a super strong dollar, collapses in other currencies around the world, even oil prices have come down a lot, and we are beginning to see a lot of companies come out and say things are slowing. So the earnings risk is mounting.
What about earnings? I mean, we saw FedEx, we saw Apple, we've seen a lot of earnings warnings out now.
So we're actually pretty far below consensus. We're at 218 for this year versus 211 last year, and then we're actually at 212 for next year on S&P earnings. So we think this is going to be pretty similar to 2015, 2016, where earnings basically go nowhere for a couple of years. And I do think companies are much more resilient in terms of managing their business models than they have been in the past. There's a lot more flexibility, a lot more ways to suck out costs, a lot more ways to manage through. Supply chains are improving, but one thing we've been telling investors is as inflation moderates, that takes a bite out of earnings because it takes a bite out of revenue. So that's a big headwind we've got next year.
So Lori, companies may be resilient. What about consumers? How resilient are they? And particularly tie that into unemployment, because if we do go this direction, what kind of unemployment are we facing?
So look, I think consumers are headed into some headwinds here, and we're starting to see trade down impacts. You're seeing a lot of those references on the earnings calls. We're also starting to see a lot of impacts among lower end consumers. Higher end has been holding in much better, but we do think the consumer is going to take some knocks. One of the things that gives me comfort is when I talk to my banks analysts, for example, they tell me the starting points on various credit metrics are looking much better than they have heading into past recessions. So we think a lot of the consumer trends are going to head in the wrong direction, but they're not going to necessarily be hit as bad as they have in past downturns, just because balance sheets have been cleaned up pretty strongly over the past few years.
And we're thinking similarly, that the consumer is having a tough time. They got hit by this high inflation. They see the high interest rates affecting the housing market. But this small recession should be marked by still an inflationary environment, not deflation. And we think the labor market will be relatively okay. They will suffer some knocks. But we don't think unemployment goes up any more than 1%, where usually it goes up 3, 4, 5% during a recession. So if it's still inflation, not deflation, and the labor market holds in there largely because supply is tight, then credit conditions, credit costs, they should be benign. That should help the banks get through this very well, and that should help investors invest in credit. 2023 should be a better year for fixed income investing.
So relatively benign. What we saw in the United Kingdom this week was not benign. No. There was a real break in the market there.
A lot of dislocations.
Do we have to anticipate something similar to that in the United States?
The short answer is no. However, what's happening in the UK is a shot across our bow, one that I hope our policymakers take very seriously, and that comes down to when you're fighting inflation and your economy is suffering supply-side shocks and other pressures, it is difficult to support the economy with monetary policy. They're hiking rates, the BOE, and it's difficult to support the economy with fiscal policy. They also have deficits. So the United States needs to be a lot more mindful about its deficits, whether it's tax cuts or spending. These deficits need to be watched in this time of rising interest rates.
So, Lori, one more attempt to put this in a broader perspective. Yeah. Great financial crisis is what we're all afraid of.
Right.
We're in better shape going into this, whatever this is, than we were that time, right?
I think we are. I mean, we again go back to our banks analysts who spend time scrutinizing the balance sheets of the big major banks, and we think the plumbing is in much, much better shape. I mean, the way I put it is the stress tests do appear to have worked. That's one of the reasons why banks haven't really been able to grow in recent years, but it is also one thing that I think is going to really be an asset to the financial markets in coming years.
And we're overweight the banks we've been adding this week.
But on the banks specifically, that's great on the banks, which is up to all the regulation. What about the part that's not subject to regulation? What about the shadow banks? What about the private credit issues? We don't necessarily know what's going on there, right, David?
Well, there's some debt in the system because debt was so cheap and readily available for the past 10, 20 years. But the banks, just as Lori said, we're confident that their balance sheets are strong. Higher interest rates, they should make higher net interest margins provided their credit costs don't surge. But a resilient labor market, home prices may come down a little bit, but as long as they don't collapse, people will keep paying their mortgages, particularly if they locked in the low rates from before.
Okay, Lori Calvasina and David Bianco will be staying with us to give us some investment advice next. That's coming up on Wall Street Week here on Bloomberg.
Frailty, thy name is woman, wrote William Shakespeare, thereby proving not only that he was arguably sexist, but that he indisputably had no knowledge of Wall Street. For the most fickle female of poetic imagination would seem a symbol of romantic constancy next to the recent behavior of the stock market. Indeed, to paraphrase that other male chauvinist, Sigmund Freud, what does Wall Street want? One thing it wanted, we were told, was Paul Volcker. It got him.
That was Louis Rukeyser, of course, calling Shakespeare a sexist, as I understand it, back in July of 1983, when the stock market was on its upward climb after Chair Volcker's interest rate shock therapy, and the bull market in bonds was just really getting started. By then, the CPI was climbing only 2.5% a year. The top movie was Star Wars 4: Return of the Jedi, and the police topped the charts with Every Breath You Take. Things I can remember, actually. And we welcome back now David Bianco and Lori Calvasina. So, given what we just talked about with what's going on in the markets, Larry, what's an investor to do? Where's their safe harbor from this storm?
So look, I think it's a question of what your time horizon is. And if you're concerned about volatility in markets in the near term and want to add some more defense to the portfolio, I think the clear choice at this point is healthcare. If you look at other defensive sectors, staples and utilities, you're basically at peak valuation relative to the broad market. We also think there's significant earnings risk for consumer staples as the consumer weakens, pricing power wanes for some of these companies, and also staples have massive exposure to the dollar, to international issues. And they're very, very sensitive to a stronger dollar. So I think healthcare, you have less of that sensitivity and you have reasonable valuations. It's not a great story, but I think it's the best one you can tell on the defensives.
So what about that? When I think of defensive, I think about things like consumer staples or utilities and things like that. Are those good buys right now?
I think the consumer staples are not a great place to hide, especially if you believe that the market is in a bottoming process. They are going to suffer from the currency hit. They still have a stretched consumer, packaging costs. So we also prefer healthcare. The thing about healthcare is that it is now the second largest sector of the S&P 500, not financials, not industrials, certainly not energy or materials. So the S&P is global, the S&P is digital, tech businesses, and the S&P is medical. Now the global parts and the foreign currency exposure aren't helping right now, and there's a little bit of valuation risk still at some of the big digital names. But the medical part has on-demanding valuations, and we are quite excited about some of the innovation that we're seeing coming from the biotech and the pharmaceutical companies, the medicine makers.
You mentioned digital and tech. There are some people, as you know, David, who say you want to go into tech right now because it comes out of a recession first.
Yeah, it is a bit of an early cyclical, and so are consumer discretionary stocks, but every cycle is different. And I think there are a few things that we have to be mindful of. I think this is going to be, the consumer will be resilient, but a lot of consumer business models might not be able to expand the way they have been over the past 10, 20 years of low inflation, low interest rates. We're trying to find which businesses have that long-term growth potential through innovation and through solving the problems that are causing us to have weak productivity. One thing is we expect jobs to hold up, but a small recession. But if you're adding jobs and the economy's not growing much, that means productivity is really weak. That's what we need companies to address that problem.
Which, Lori, I think takes us back to something David said earlier, which is it depends on what you think the comeback, because sooner or later there will be a rebound. What does it look like?
Right.
Is it a V or is it more gradual? Because that will affect which one is the better place to be.
Right. I think if you're thinking about rebound plays, I think you do want to look to some of these beaten up growth areas. I think you want to be very selective. I think you want to stick with quality. I think you want to stick with bigger market caps. But technology is an area that we think looks really, really interesting with reasonable valuations. Areas like semiconductors look to me like they've bottomed out in terms of earnings sentiment. Basically, nobody is taking numbers up there right now, and that's usually a good contrarian buy signal for that part of the market. But, you know, going back to kind of what does this recovery look like, if you think it's going to be a hot economy, you want to buy value stocks, you want to buy cyclicals. But if you think it's going to be a cool economy, you do want to buy secular growth-oriented areas of the market. They typically outperform when GDP is below 2%. And I think that is probably the kind of recovery we're headed for.
What about small caps? How do you feel about them?
You're asking me to talk about my first professional child. So I spent a long time covering this space. And I think people who have covered this space for quite some time realize that in the middle of recessions, in the middle of these very challenging periods economically, this is when you do want to buy them. And if you look at small caps, they've been in a trading range versus large all year. There's some stability in the performance. They're mostly domestic. They're very cheap on valuation, basically at the bottom of their historical range. And small caps are already pricing in a collapse in ISM manufacturing to typical troughs and a big spike in jobless claims from here. So I think the recession is largely baked in. And this is where you typically want to be on the rebound. And people want domestic U.S. exposure right now. So.
Well, what about that issue of domestic U.S. exposure? Do you want to hide in America?
You want to hide in America for now, yeah. And we are looking for businesses that, like Lori said, the ones that will have a strong rebound. We want to be a little bit careful on small caps and semiconductors for a little longer, but those are ones that will likely have V-shaped price recoveries once we get past this. The cousin of technology is communications, and that's been beaten up very badly this year. We think that's overdone. So banks and communications, entertainment companies, internet companies, we think that's an area where investors can start stepping up and buying where the reward should be worth the risks.
Lori, I know you've been going around the country talking to people. What are you hearing in terms of what they're interested in? What are they nervous about when it comes to investment?
So it's funny. I mean, nobody feels particularly bullish right now. But I think there is a general recognition that people have plenty of defense in their portfolio, plenty of safety trades. And so they are concerned about when does the market bottom? What do I need to own coming out on the other side? Because I think there is a general recognition that when the rebound finally does happen, they're underexposed to the kinds of things that do well in those rebounds.
Do you hear from people, I don't want to be in equities no matter what they are? This is not the time to be in equities.
I don't hear that. I mean, to be honest, you know, as I've talked to some of my more bearish kind of global multi-cap, multi-asset investors, I can usually talk them into looking into small caps right now. So I think kind of the desire to kind of put everything in cash is just not something that's in the DNA of a lot of these people. But I do think even the most bearish investors out there are trying to figure out what has been de-risked and if there's an opportunity to put money to work in here. And ultimately, that is very healthy.
David, what about bonds? Is it time to go back into bonds?
Well, I think it's more of a 2023 environment to go into bonds right now. You know, very short duration, cash, and trying to find the equities where the upside is worth taking the risks and the pain and the volatility are likely to go through the next few months. I think this week frayed nerves, though. A lot of people were fairly calm up until this week, and even today didn't end very well. So we still want to be a bit cautious. We are acting on this dip. We are buying it, but we're also keeping dry powder with cash. And it's probably best to just keep in mind that this will be a market that I think has a rally during the holidays on the idea that the Fed is done hiking. They won't cut anytime soon, but they'll be done hiking probably at the end of the year. That probably gives us a rally, but I think we find ourselves at these levels once again early next year in the spring.
Lori, we've talked about the strength of the dollar, which has been a real phenomenon, right? How does an investor take that into account? What does that tell me in my portfolio?
It's a tricky issue because typically when the dollar is strengthening, it's a bad environment for equities. So you tend to see the market go down. But at the same time, we do usually see U.S. equities outperform non-U.S. equities. So I think you can still look to the U.S. as a safe haven. And I think, frankly, it's just all about the positioning. So you want to be more wary of areas like industrials, materials, consumer staples, which have that big dollar exposure, and look at areas like financials, and which have less of it, frankly.
David, aren't a lot of people going to cash or cash equivalents?
Yeah, and
that's sensible?
Well, it would be good if you've done it weeks and months ago and begin to deploy some of it, but keeping some cushion, that way you keep your confidence should things get worse and more turbulent. Cash is not trash, but if you hold on to it for too long, it begins to rot. So we are deploying some of it, but we are still, braced for what we think will be turbulent times.
What do you think about cash, Lori?
Well, I'm an equity strategist, so I'm always going to want
fully deployed all the time.
I think there are opportunities and things to do if you have a longer-term time horizon. So, when we look through the Russell 2000, for example, we can find about 18 different industry groups out of 60 some odd that look like they're washed out in terms of earnings sentiment. We can find about a dozen in the big cap space. So I think there are things to do, but I do think you have to have a strong stomach. And I am mindful of the fact that when these bottoms happen, they tend to be very quick. No one ever pegs the bottom. So I think kind of moving in slowly and buying things that make sense longer term is what I'd be doing here as opposed to hiding in cash.
One last one, David. What about liquidity? Do you want to be liquid right now? Do you want to, whatever investment you make, whatever it is, make sure you can get out of it pretty quickly?
Well, there's nothing more liquid than cash. Yeah. And treasuries are, of course, the world's most liquid security. And that's part of the reason why you see the dollar so strong right now, for a lot of reasons. Things are more difficult elsewhere. The Fed's raising interest rates, and it's the world's most liquid security. So yes, I think what you're seeing is that people want to have that cushion and that liquidity, but they'll be looking for opportunities to deploy it in the coming months.
Okay, thank you so very much. It was great to have you both. That's Lori Calvasina and David Bianco. Coming up, we're going to look ahead at what's happening next week on Global Wall Street, here on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. It's time now to look ahead to next week on Global Wall Street, starting with Juliet Sally in Singapore.
Thanks, David. Central bank decisions will take centre stage this week in Asia, with the RBA and RBNZ set to extend their tightening sprints to beat down inflation. In contrast, Bloomberg Economics expects Sri Lanka's central bank will probably wager that it's done enough already. Elsewhere, the Bank of Japan's Tankan survey is likely to show slightly stronger business conditions as the end of Shanghai's lockdown and smoother supplies of chips probably helped manufacturers. While Indonesia's headline inflation likely jumped in September, propelled higher by the government's fuel price hike.
This coming week in Europe, it's another potentially volatile one for the UK, with the fallout from Kwasi Kwarteng's mini-budget still being felt. We're having a Conservative Party conference as well at a time when their approval ratings are at historic lows with the most recent polls. Will the government do a U-turn on their plans? Liz Truss has also reportedly met with the OBR. Are there any outcomes from that? And what impact will policy continue to have on a UK market that sells off, forcing the BOE to intervene?
A slew of economic data on tap for U.S. markets in the week ahead, including construction spending, factory orders, mortgage applications, and ISM manufacturing and services numbers. Now, investors also will get a fresh look at two key labor market reports: the Job Openings and Labor Turnover Survey, which is released on Tuesday. The so-called JOLTS data is an important one, as Fed Chair Jay Powell has cited the report's insightfulness for gauging tightness in the labor market. There are now about 2 jobs available for every unemployed person in the country, the biggest ratio since that data began being tracked in the year 2000. The other big release will come on Friday with the September Payrolls report, which is projected to show another month of robust job creation and an unemployment rate well below 4%, near the lowest levels in the post-war era. Now, under most circumstances, this would be lauded, but the labor market tightness has become cause célèbre, with the Fed making clear its success in fighting inflation depends in part on softening labor market conditions. David?
Thanks to Julia Sally, Danny Berger, and Romaine Bostic. Coming up, we'll get some advice on where investors should hide out in these turbulent times from Nuveen CEO Jose Minaya. That's coming up next on Wall Street Week on Bloomberg. That rainy day is here. Everywhere you look, economies and markets are struggling, with Jason Furman of the Kennedy School saying Europe may be in the worst shape.
I think Europe is one of the biggest risks for a recession.
Even as the world was also focused this week on the United Kingdom and the British pound, something the British opposition party hammered home.
What we've seen in the past few days has no precedent. The government has lost control of the British economy. And for what? They've crashed the pound.
But what happens in the UK and Europe doesn't necessarily stay there, as Atlanta Fed President Raphael Bostic pointed out.
What we've seen in terms of market reaction is that the proposal has really increased uncertainty and really caused people to question about what the trajectory of the economy is going to be or might be moving forward.
All of this leads Alvaro Pereira, the chief OECD economist, to take down growth estimates overall worldwide.
Our forecast certainly is a challenging one because we are forecasting a significant slowdown of the economy to, say, the United States growing at 0.5% next year, the euro area growing 0.3%. Globally, we're talking about a significant slowdown.
Right now, it looks like more than just a rainy day. We may be headed into a real storm. And if so, where are the ports for the smart investor to head into as we batten down the hatches? And we welcome now someone whose job it is to figure out how bad the storm is and where we should head as investors when it happens. He is Jose Minaya. He's the CEO of Nuveen. Welcome back. Great to have you, Jose.
Hey, thanks for having me, David.
First, on the storm, as I'm calling it, how bad is the storm, do you think, economically?
Look, the storm is choppy, but it hasn't really changed much in our view, right? I think going into now the latter half of the year, we still see volatility ahead, but you know, the fundamentals are strong in that you're seeing consumer household balance sheets are really good, the labor market. So we're not really forecasting a prolonged downturn or recession. That being said, I think our view is the same it was back in 2019, right? We've been telling our clients, be prepared for lower returns in the previous decade. Be prepared for more volatility. And by the way, inflation, while you haven't seen it for a long time, it may show up. And here it is in our shores, right? So for us, it's about staying invested, staying disciplined, maybe more defensive today, but always diversification, right? It's not just about stocks and bonds. Now it's about alternatives. How do you get more outcomes and solutions? Because there's really nowhere to hide in a world where all correlations go to one.
Well, let's talk about that exactly. As we have a Federal Reserve and other central banks raising rates, and it looks like they're going to continue doing that for a while, it necessarily takes asset values down, whether it's stocks or it's bonds. And we're seeing that, goodness knows, in the markets overall right now. What do you do if you're an investor in that world? Are there some assets that are better than other assets?
Well, look, one, I would say this is where active management, I think, comes back into the fold, right? So there's going to be winners and losers. Clearly, in today's environment, we see buying opportunities. You have to be careful of value traps as well. But then you think about inflation, rising rates. Well, if you look at middle market bank loans, senior loans, well, they have floating rate paper. You think about getting more exposure to commodities, things that have a higher correlation to inflation as well. Real estate. These are all the different mixes. That's why when I talk about diversification, it's like there's active management, but there's also, you can be more explicit and intentful to ride the wave with, benefit from rising rates, to actually be highly correlated to inflation in an inflationary environment.
In active management, you're going to have exceptions to any rule, so you have to be careful. But as a rule, is it a time to stay away from equities because that discount rate is going up and that automatically just reduces the value of the equities?
I would never say it's time to stay away from equities. Obviously, when we believe in staying invested. That being said, today on the margins, we see more value on the fixed income side versus credit. We see more value actually in high yield, right? You've got a high yield market almost topping 8% in yields. Maybe again more active management there, picking the better credits, stronger credits. So yeah, on average we see a tilt more towards fixed income, a tilt more towards private markets. But I would never say completely stay away from equities.
So talk about high yields, because I've heard others suggest that's sort of almost a substitute for equities in a way. And obviously we're getting some bigger returns now. But we're getting bigger returns for a reason. As we're worried about a recession, a downturn, you're worried about some of those companies not being able to pay back the money.
And by the way, we acknowledge that actually spreads can continue to widen from here. That being said, when you look at a risk-return perspective, you look at some of the most attractive pricing we've seen in quite a long time. These are still the areas where, again, active management, picking the right credits, maybe still being more defensive, picking the stronger credits, but the yield versus the risk that we're taking and the pricing you're seeing in equities versus the high yield and the fixed income market. Today, we see more opportunities there. But look, this is, we're in year 3 of this kind of quote unquote interesting and challenging year. Guess what? I think 2023 is going to be more of the same of that. You're going to have volatility. Now is the time to, again, stick to your discipline, stick to a diversified portfolio. But then again, actively, you can find these pockets where you can do well.
In that diversified portfolio, you think it's time to take another look at municipal bonds?
Oh, I do. I mean, munis, if you think about it, right, they've had a pretty rough year in terms of redemptions out there. Yet, from a credit profile, they're stronger than they were last year. They're better from a yield perspective. I think that's a market that's kind of looking at Fed policy and where rates are going to settle. But today, munis are looking very attractive, and I think you're going to see a lot more flows going into the muni market.
But even within munis, though, do you have to have some discretion, some active management of which munis you're buying?
Absolutely. We've shown that over the years, whether it's decisions to be in Puerto Rico, not Puerto Rico. Not all municipalities are created alike. And again, that goes back to, in an environment like this, again, active management is going to be a bigger trend than it's been in the last decade.
Jose, you mentioned alternatives, particularly real estate. What are you looking at right now in real estate?
Well, the markets that are extremely strong in real estate for us today would be the industrial market, things like warehousing, logistics. Multifamily housing is very strong. Retail, amazingly, it's come back significantly. We've seen more openings and closings here in the U.S. Office market is, again, still a little bit lagging there. But again, there's an example of we focus around diversifying our own real estate portfolio, and you're able to pivot quicker into these different themes.
Last time you were on Wall Street Week, we were talking about agricultural real estate. Yeah. Has that picture changed since we last talked?
Well, imagine this, right? It's just become so much more attractive, right? When we look at an asset class like farmland, and there's others that we look at it that way, we talk about an 8% return. You're clipping a 4% coupon. It's pretty boring. Well, in this environment, and by the way, a hedge, highly correlated to inflation. These are the asset classes where I think historically people understood it academically, but hey, you know what? The S&P is going up 15, 20%. It's kind of a hard trade-off. Today, I think these are the asset classes that make a lot of sense, whether it's the real estate sub-asset classes I talked about, whether it's timber, whether it's renewable infrastructure. Now that alpha is real because you're smoothing out your returns and you're having a higher yield component and one that's highly correlated to inflation.
Put all this discussion over against demographics for a minute. We're in National Hispanic Heritage Month. I'm very mindful of that. How does this work differently, perhaps, for some Hispanics?
Well, it works very differently, and a lot of it is about inclusion. What's amazing to me is you look, the Hispanic population is the largest minority population in the U.S. It is the fastest growing population in the U.S. If you think about the GDP that it generates, if it was a standalone country, it would be the 7th largest GDP in the world. So one, tremendous buying power by this population, right? So I think there's a business opportunity here. But what's amazing within that demographic, less than a third of the Hispanic population has access to retirement services or advice. And again, in times like this, I think that hurts that community even more. So again, I think we have to kind of reach out from an inclusivity perspective. But I often tell my peers in my own firm is it's also a massive opportunity. Again, a lot of buying power, highly underpenetrated in advice and in retirement products. I think it's just a huge opportunity.
So what lies behind that great disparity about access to retirement advice, investment advice? Is it the nature of the jobs people have, so they're working in positions that they don't naturally come to it? Is it because we don't have the financial institutions in their areas, in their communities?
There's two things. One is financial literacy, right? And then just kind of really kind of engaging that community and driving higher financial literacy. The other one is just pure diversity and inclusion, right? I remember starting out my career looking at marketing materials that were all driven in Spanish because there was more clients and customers that just spoke Spanish. And I read it, and I'm like, well, this translates really well, but my mom would be pretty insulted by this. And you're like, how does that happen at a large company with, they probably paid a lot of money to an agency? Well, there's no one sure there were people in the room that can translate to Spanish, but there was no one in the room that really kind of understood that journey, understood that culture. And I think to me, that's also what's missing. As we get more inclusion and diversity, we're able to better access these markets. And that's why I've always said this is a bottom line issue at the end of the day. There's a lot of money firms are leaving at the table by not engaging that community better.
Yeah, and it helps to have somebody at the table who understands that community.
Exactly.
Okay, thank you so much, Jose. Really appreciate it. That's Jose Minaya. He is the CEO of Nuveen. Coming up, we'll wrap up the week with our special contributor, Larry Summers of Harvard. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston, and we're delighted to welcome back once again our very special contributor here on Wall Street Week. He is Larry Summers of Harvard. So, Larry, maybe not the most consequential thing, but certainly the most noteworthy thing in the markets this week was the Bank of England saying they're going to buy an unlimited number of long-term gilt bonds to try to stabilize the marketplace. I know there was a specific problem there, but does that indicate something broader about the markets?
David, we're in very complex and uncharted territory with what's happening in the UK, and wouldn't amaze me if we had situations like that in more places. Look, the UK has fundamentals that are out of whack, in which the market does not believe that they have a sustainable path of macroeconomic policy that over time, no matter what interventions you do, spells very difficult times for their long-term bonds, for their currency, for their rate of inflation, and ultimately for their economy. They pursued yesterday what's called in this little field a market maker of last resort option, at a moment when there were huge margin calls, and so there was great selling pressure but no buying pressure on long-term bonds. They committed to step in and buy for the next 2 weeks, and that, for a time, stabilized things. But it's not going to stay stable forever on the basis of 2 weeks buying, and it's probably not even going to stay stable for 2 weeks unless there is a sense that this is a bridge to the fundamentals being fixed. And that's not what we are seeing from the indications we're getting this morning. That's why I encouraged the IMF to make clear that it was monitoring this situation, and the IMF made clear that it was concerned, even adding some editorialization on the regressivity of the tax policy, of the tax code, which I'm not sure is their usual role. But there's got to be real concern.
So, Larry, it's clear the Bank of England stepped forward and saying we are willing to be, as you say, the market maker of last resort. Are some other central banks going to have to potentially step up, at least be willing to step up and be a market maker of last resort? What about Bank of Japan? What about, for that matter, the Federal Reserve?
I don't think there's any sign that I see yet of other markets being disorderly. But we know that when you have extreme volatility, that's when these situations are more likely to arise. When you have extreme volatility coupled with substantial leverage, coupled with substantial uncertainty about what's going to happen in policy, layered on top of the kind of uneasiness that you have with high rates of inflation underlying, and with the kind of geopolitical and commodity uncertainty that's coming out of what's happening in Ukraine and China. This is certainly not a time when very many firefighters should be taking vacations. And so I've got nothing to predict, but I do certainly think we're living through a period of elevated risk, and that earthquakes don't come all of a sudden. there are tremors first. And most of the time when they're tremors, they're just tremors and it goes away. But not 100% of the time when there are tremors does it just go away. And so in the same way that people became anxious in August of 2007, this is a moment when there should be increased anxiety.
So, Larry, a couple more reasonably quick ones. Number one, should the Federal Reserve be particularly nimble at this point? You said it's incredibly complex. Some people think they've built in so much momentum on the rate hikes that they should actually consider how they can adjust to the data.
Look, I think after a long time when he was still captaining Team Transitory, I think Chairman Powell is now in the right place. I think Chairman Powell is saying that he sees the centrality of inflation as the concern. He's also saying, which is just the right thing to say, that while it's their plan to move vigorously to the point where monetary conditions are restrictive, and the 3% interest rate they have right now is not restrictive. Their plan is to move to a restrictive place, and that's appropriate. He's also making clear that they're going to maintain their peripheral vision on what's happening to the real economy and certainly to the emergence of financial strains. So I think that is broadly appropriate. You know, I certainly have written the sentence many times about long and variable lags, and that is a real feature of the difficulty of doing monetary policy now, David. I think it's worth remembering that when you're in a regime of signaled policy, I suspect the lags may be a bit smaller than they otherwise would be, in the sense that the response to, for example, the hike that will come in December is probably already happening because it's been factored into prices, has fed through into medium-term rates.
It's a really interesting point. Larry, one last one. You really tweeted a fair amount about the Jones Act this week. Finally, there was a suspension of it with respect to Puerto Rico so they get some of that fuel on. Explain to us why you're so wrought up about the Jones Act.
So look, the Jones Act was Woodrow Wilson's Buy America industrial policy. They had the idea that we'd require that stuff being carried between the United States, between Houston and Boston to Puerto Rico to Hawaii, would have to be carried on U.S. ships, because that would make us not dependent on foreigners and make us more secure. Whatever the logic of that idea when they had it in 1920, it makes no sense today. It means we can't get natural gas from Texas in New England today because there are no U.S. registered natural gas tankers. It means that vitally needed fuel was sitting off Puerto Rico for days because it happened to be on a foreign ship. It means there's an incentive to send stuff to Europe and to import stuff from Europe because the shipping costs are lower, even though the distance is longer, because we can use foreign flag carriers. So it makes our economy work less well. It makes us be less environmental because the stuff goes on trains or on cars rather than over the water. It reduces competitiveness because inputs of anything you have to ship costs more. And the reason this is important is it's important to the health and well-being of a couple million people who've just been through a hurricane on Puerto Rico, and eventually, the Biden administration got that fixed with the exemption. But the deeper point is that this demonstrates the danger of Buy America industrial policy. Right. To preserve 4,000 jobs, this is not the stuff of a great nation. It's the stuff of parochial politics, and we should be trying to do less of it, not build on its example. And that's why I'm apprehensive about where this will go unless it's very, very carefully managed.
Larry, thank you so very much for being back with us. That's Larry Summers of Harvard, our very special contributor here on Wall Street Week. Coming up, trying to repeat economic history, or at least to make it rhyme. This is Wall Street Week on Bloomberg. Finally, one more thought. Mark Twain famously said that history does not repeat itself, but it does sometimes rhyme. And we have certainly seen that recently. And everything from the echoes of Roger Maris with his record-setting 61st home run, that came actually 61 years ago, and that is now echoed by one Aaron Judge, also of the New York Yankees.
One of baseball's greats, be enshrined with him forever is, it's words can't describe it.
To Russia, going to war confident of a big, quick win, as it did with Japan back at the very beginning of the 20th century, only to lose ignominiously. Something that it certainly hasn't done in Ukraine, well, at least not yet. But boy, has it gone less well than Vladimir Putin ever imagined it would.
To have Ukraine conducting a strong offensive that's working is incredibly important to putting real pressure on both Putin and the Russians.
And this week, we saw the leader of the political party descended from Benito Mussolini rising to lead Italy 79 years after El Duce fell.
Giorgia Meloni accomplished a threefold success, political success, so her party clearly emerges from these elections as the clear winner of these elections.
So now we're hoping for a very different sort of historical rhyme, as the current Fed chair, Jay Powell, is hoping to replicate some version of what his predecessor, Paul Volcker, pulled off 43 years ago, with a series of dramatic interest rate hikes that brought runaway inflation in the United States to heel, something Mr. Powell is not subtle about saying he'd like to repeat one way or the other right here, right now.
The successful Volcker disinflation of the early 1980s followed multiple failed attempts to lower inflation over the previous 15 years.
And as we hope that Jay Powell does get his way on inflation, might we look for something similar on the strong dollar? For soon after Chairman Volcker got his arms around inflation in the United States, the British pound back then started to collapse, something Treasury Secretary James Baker wanted to fix to help his boss's friend, Margaret Thatcher. But on that one, Secretary Baker took the lead by coordinating with other finance ministers, while the Chairman Volcker, went along, if somewhat reluctantly. So if history rhymes on the strong U.S. dollar, Britain may need to wait for inflation to come down before it gets any U.S. help for its pound. That does it for this episode of Wall Street Week. I'm David Weston. This is Bloomberg. See you next week.